All right, thanks everybody for joining us on the lockdown. You got nothing better to do, obviously, so you came and joined me. Hopefully, you'll get some great content out of this. This is going to be on the long put calendar. We did some diagonals last week. This is a bit of the same where we're using different months with the long put calendar. I won't even teach a short put calendar, so just the put calendar is probably what you'll see from me when I'm referring to this. The reason why is because I don't like that much risk in that back month, that further duration. There's no sense. And I'll go through why it is not a good idea to do something like that, or at least make it pretty obvious in this webinar. But the long put calendar is going to be really great for more of a neutral. You kind of want this trade to actually go against you, like in a long put calendar. We're going to be wanting it to almost rally just a little bit. Which is kind of what we're getting right now in the markets. We've gotten this bounce, right? Now, if you're thinking, well, right now I think we're going to get this bounce, but there's some companies out there that are really going to be affected negatively by everything that's going on. And during that earnings cycle or whatever is coming down the pipe, or down the pike is going to send us lower in this particular underlying. So, a rising tide lifts all ships, but we start to filter out the good and the bad a little bit later down the road. So I think that that's kind of what's happening right now. And we'll go over this. If you guys have some stocks in mind that you think are getting this unnecessary bounce with the rising tides lifting all ships, and we can take advantage of it down the road, then we're going to open it up to you guys to throw it out to me, and we'll go over some of those. You guys drive the content in these webinars quite a bit. I can go over my stuff that I've looked at, but I think that you will get a lot more out of it if you're asking questions. Think about it this way. If you have a question, somebody else has that same question. They just aren't reaching out in the questions box, and that's how we'll communicate back and forth. All right. So this is on the long put calendar, and this is on implementation of options into your portfolio. And it's a lot of times I struggle when I'm building out a course, because I don't know what's going on down the road, right? Well, this particular course, all of these have kind of filtered out quite nicely for the market reactions we've been getting on a weekly basis. So, it's very relative to what's going on. Sometimes I have to struggle, but right now it's pretty lined up nicely. All right, so let me go over a couple of things. You see the long put calendar screen. Did this start yet? Yes. Can you not?
The broadcast is now starting. All attendees are in listen-only mode.
All right, yes, this is being recorded. Sorry, you guys. I don't know if everybody could hear me on there. This is being recorded, and something we want to talk about here is the long put calendar. I won't even teach the short put calendar, all right? The reason why is because I don't want to have that risk on way in that back month. That's the short put, right? So I want to put that short put in the front month and have my back month have the long put. Now, with this strategy, we're looking at a very neutral bias. Like you really, the best profitability in the duration of that front month is if you nail the number. And we'll talk about that a little bit more. But ultimately, the idea with this one is you kind of want to be wrong in the beginning and then later on have it kind of filter out to where you are right, in the sense of a rising tide lifts all ships. Okay, so right now we've had this big sell-off and now we're getting this bounce, right? And it's lifting even some of the names that aren't going to do well in this type of environment going forward. All right, so it could very well be the right timing for this type of strategy where we get a bit of a bounce going on to the upside, which is kind of counterintuitive to long put, right? We want it to go down. Well, if you get that little bit of a bounce and you can get that front month to decay out rather quickly and not have it tested, then you can ride out that long put for the duration. So that's one way to play it. Ultimately, what you want to do is kind of nail the number where at expiration of that front month, it is pinned right there at your short and long strike, because with the calendar, you're picking the same strikes. Okay, so It's a little bit counterintuitive. We may want a little bit of a bounce, but we ultimately want it to come back down to where our strikes are. And if that front month decay is worthless, then we can ride out that long put. So that allows us to stay in this trade a little bit longer. Okay. It is a defined risk strategy. And something about this particular implementation of options into the portfolio, if you haven't been staying through to, yeah, I'm just talking about the front screen here first right now, John. Everybody can see my very first screen. I'm just kind of chatting right now. But if you guys have been following along with this particular course, you know, a lot of times with other courses, I've kind of struggled because the environment doesn't always match what is going on, particularly right then and there, because we plan these things out for several months in advance. And this one is really lining up quite nicely with what's been going on. I mean, we were talking about selling calls against our underlyings at the very beginning of this sell-off. So those strategies worked very well. So this course has really lined up well with what's going on. And now we're getting this bit of a bounce. I think that there's some stocks out there that have gotten a bit of a bounce that probably shouldn't be, and we can take advantage of that with this particular strategy. So without further ado, let me get on with this. My name is Eric Wilkinson. Some of you guys may recognize me from mainstream media. I started out trading in college, you guys, with a psychology degree. Yes, I wanted to be a psychologist. And when I deposited some money into this local bank, the guy asked me if I wanted to start investing in this because it was a nice chunk of change back then. And you know, I first said no, but then I started looking at the Wall Street Journal and started buying a couple of stocks here and there. And then I started trading options on it. So I was like, I'm flipping this over to finance. And after graduating college with finance, I moved straight to Chicago. Started working on the floor as a runner, like one of these guys down here running around. Moved into the pits, was an ARB clerk here, and then started trading on my own. So I've gone all the way through the cycle, really, and have been trading my own money ever since. So I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products in just about all market conditions. I have to say that this market condition we're going through right now is probably at the top of the list of what you would ever see. So if you've been trading through this, you can probably rest assured that you will not see this for another decade or more. At least I hope for everybody's purposes. All right, basically, go take a minute to go over this disclaimer. It says any opinions, news, research, and analysis or other things contained in this webinar is for general commentary, does not constitute investment advice. You guys, I am not here to give you guys trade recommendations. I don't believe in it when people give trade recommendations because I don't know if it's appropriate for you. You might have a completely different market assumption on something than I do. I would rather you guys learn to come up with your own market assumptions, find out what the environment is, and do that process in your mind as to, is this the right environment for this? What do I need for the duration? And all of those things start falling in, and it will lead you to the right option strategy for that market assumption and everything else in the environment that's going on and around you. All right. So I don't know your investment parameters. I don't know what your risk tolerance is. So therefore, there's no way I would give you a recommendation. All right. So go over that, and please remember past performance of any trading system or methodology is not necessarily indicative of future results. All right, you can follow me on Twitter at Wolfman's blog. Our parent company is at ProTraderStrat. We also have a Facebook page where we're throwing out all kinds of content at ProTraderStrategies.com. So make sure you follow us on Facebook so you can get access to those almost immediately when I get those done. It'll be definitely a lot closer than if you're trying to find it on YouTube or anything else there. All right, so we are doing the long put calendar here, but I see a couple of questions popping up. Can't wait to see for the pullback from the long-term trend and set up for a put strategy. That's basically what we're doing here is we're going to be trying to take advantage of, this little bounce. I've done a couple of webinars recently, sell the rips, buy the dips. Well, we've been getting a couple of rips here, and I think that you're going to see some other things to make this market come back. I don't know that we're necessarily going to see a massive V-shaped recovery. And I don't know if we're necessarily going to test those lows that we've just recently seen unless something really terrible starts to happen. So at least in the short term, I don't know that we'll necessarily test those, but that doesn't mean that there won't be, and that's broader market speaking, okay? But I do believe that there are some stocks out there that have gotten a bit of a pump up here that may not be worthy of the pricing that they're getting right now, for lack of a better word. And I'll talk about what I think, and I'm going to throw out stuff for you guys that you guys can throw out there. Compared to the long put, can you comment on? Yeah, I'll do that, Wally. I'll do that towards the end. The problem with the long, he's asking about the butterfly or the iron condor compared to the long put calendar. Well, they all have their benefits and their drawbacks, right? Right now, the condors, despite the fact that, you're really picking a great strike location with that one, the problem with the condor is that, you're seeing that get tested quite a bit, especially with the volatility, despite the fact that the volatility is allowing us to get further away. The VIX is pricing in 5% moves, and we're seeing those strikes get tested quite a bit. The nice thing about the condor, though, is that it does have defined risk, so you know where your risk lies. But that versus what we're talking about here with the long put calendar is that it's great for like a near-term bounce, and you have much more upside potential if you're right to the downside. Especially if it comes down to your strike location and stuff. So, with the iron condor right now, I like that better, and a little bit in more volatile markets for sure. It is appropriate, but these, it seems like that those haven't necessarily been working out in the last month, let's say. Okay, so I'd be a little leery of something like that, but with this, we're able to define our risk and things of that nature, okay? Just like with the iron condor and the butterfly. I don't love butterflies for a lot of reasons that watch the butterfly webinars. We talk about strike locations and stuff like that, but that's not one of my favorite strategies, to be honest. All right, so how do we set up the long put calendar? It's pretty easy, you guys. It's a long horizontal spread, all right? Basically, 2 different months, but we're using the same strike. So these at the monies, you're picking one or the other. The at the monies, I like to generally go a little bit further out of the money on these. Gives me a little bit of wiggle room to be wrong. If you're at the money, you are pretty darn neutral. If you are out of the money, you're kind of playing this for a bigger downside move later on down the road. I don't have a problem with either one. If you're picking the at the monies, you're probably picking about the 45 delta strike location, and if you're doing the out of the monies, I'm just going just slightly further to the 36 delta. It just gives me a little bit of wiggle room to be having this go down relatively quickly. All right, now I'm going to go over the max profit, max loss, and break even. Now the max loss is a given. It's relatively easy because it's a defined risk strategy. The problem with this strategy, though, is that the max profit is realized when the stock price at expiration is equal to the strike prices that we got. So right now, let's say XYZ is trading 40 and we pick the 35 puts, right? So if at expiration it's trading 35, that's the most you can make on this strategy before that short put expires, okay, that we talked about, because they're different months. But it's very difficult to come up with it because volatility and everything else and how soon this happens is always a question mark in here. So, but if you're really looking at it, your max profit is equal to that strike price that we pick, goes down to that strike price on expiration. And one of the floor trader hacks is that we used to use is kind of like your max profit is in a sense, if you're paying $2 debit, all right, for this strategy, well, if you're risking one to make two. So if I risk $2, my profitability would be making $400 on this trade or something like that, or if I paid $2, then I would make $4 if I were exactly right. And it's not always necessarily to that button, you guys. Everything can change depending on volatility and everything else. So that is going to really be the thing that affects that. So yeah, because the long put is retaining that time value, and that front one is decaying. So since that front month would expire worthless at expiration, if the underlying came right down to my strike price, that front put would expire worthless, and our back month put, that long put, would be retaining a lot more value in theta, right? We talk about theta in a lot of these. So let me just pull up the platform here and get over here. So if we take a look at this, so this is the ones that's pretty close to the wheelhouse that we would be using. And we just look at the calls and the puts, but the theta up here, you can see is, like 12 cents. And then if we go back to the back months, which is about where we're going to be looking at, the theta is 4 cents. All right. So during this next 22 days, our front strikes are going to decay a lot faster than, say, our back months. Okay. So that's what we're looking for. This kind of theta decay versus this kind of theta decay, because we're selling this one and we want this one to decay, and this one we're going to be buying and we want that one to retain value, right? So if we were to do something around this one, Las Vegas Sands, let's say it's trading, close to $48. I talked about doing the 36 delta. This is the one that we would be selling, and then we would be buying the same strike on the 45s here on that one. So you can see that the theta on this one is decaying a lot more than the theta on the one we're buying. So we're going to retain value here. We want this one to go to zero. So the max profit would be achieved if on on April 17th, this is trading basically $45.01. That would be basically your max profit on this. We came down and traded on the last day, it was settled $45.01. You would achieve your max profit. And a guesstimation on that would be, if I'm risking $2 here, then this would go out like $4 and some odd cents. So as a credit, when I sold it out, it would go out at $4 and some odd cents. Okay, that's a total guesstimation. It's a floor trader hack that we used to use. It is not anything that is written in stone. It's more like written in water in a sense. It's just to give you a ballpark idea as to what your risk parameters are. And, I'll go over right now, your max loss is going to be the debit you paid. You can't lose any more than the debit you paid. And we can throw it over here to the Analyze tab just to check it out. And you'll see that the risk parameters on it. Let me pull this over. It's a little bit skewed to the upside, so you can see it's got a little bit of skew there. And again, your break even is going to vary quite dramatically. Now, one of the things here, it's showing that it's at 35. It's like $10 lower than where we currently are. What we used to do on the floor is just double this and kind of either subtract the debit from the long put, would be a break even, or kind of double it right now because the volatility is so high. But that's just your guesstimation. And that's another floor trader thing that we used to do, is subtract the debit from the long put, and that's your break even to the downside. And that is very conservative. Okay. Your break even is usually better than that, as you can see what this is setting up. And again, here's what I was talking about. Your max loss on this is $2.20. You can see that that's where it kind of flattens out down here along this. And then I said you kind of double it. That's about where you're going to get for your max profit. You can sell it out for a $4 credit. That's about where you're seeing that pinnacle be. So it gives you an idea. Those are all ballparks. it doesn't always necessarily come exactly that way and can change throughout. Max profit when the stock comes down to the short strike. It's yes, or both strikes are the same. We got a 45 and a 45 because that makes it a calendar. If they were different strikes, we would have a diagonal. But yes, if the underlying traded right down there to 45.01 is probably where that actual peak is. 45.01, because then that would make these short puts expire worthless on the last day of trading. Okay. And these long puts would retain most of their value and would gain a little bit as the market came down, but would gain a little bit as it came down to there. So, all right. That doesn't look like a good calendar. Vol is too high. Well, we'll talk about that. You know, what we want to do with the calendar, and that's a great question, is we want to isolate volatility. That's one of the main objectives here, is to isolate or at least not have a ton of exposure to that volatility, right? Because if we buy something for a debit, right? If we're doing a debit, well, we don't necessarily want to be buying a put necessarily in a high volatile market. But what we're trying to do here is we're going to isolate this volatility. And I'm going to go into that in a little bit more detail here in a second. But I want to get you guys a little bit of an idea as to what we're looking at. So max loss here is the premium we paid. We talked about that. Anytime you're paying a premium, that's your max loss on this. And your break even is going to be when that long put option minus the premium paid. And that, again, is what I'm talking about. It's a total guess on where that break even actually happens, because there's so many variables that's going on here with the volatility, the theta decay, and how fast this goes down there. So our ballpark is to just subtract that debit paid from the long put to the downside. You can even look at it as to the upside. It's basically from where your inception is plus the premium paid. To the upside is your debit paid. So in our example, we were looking at $48, right? At $50 as a ballpark, and that's very, very conservative, would be your break even. It's actually much more than that. It's like 2 times that figure, but you can't really come up with it necessarily exactly, unfortunately. All right, now we are, I love this in this environment though. This is where the volatility, are you using the calendars to go long cheap? Yeah, what I'm trying to do is exploit this volatility we're seeing in these front months, because normally volatility, and I was going to talk about this on the environment, volatility usually affects further duration more than what the near duration happens. So if you start seeing volatility, it's expected that volatility is going to kind of continue. But we're seeing a bit of a completely different environment right now, where volatility is really pretty isolated here in the near future, as opposed to down the road, which is nice. We can take advantage of that. Why? Because we're selling volatility that's expanded dramatically in this front month. So we're getting paid for that volatility in the front month and able to buy a lot cheaper volatility in the back. Now, historically speaking, the volatility in the back is pretty darn high still, but we're getting paid off by taking that volatility in the front. And I'll talk about that in a minute. Picking the right underlying. When I'm talking about this, it's during open market operations, and we're looking at XYZ or ABC. So if it's XYZ, let me get my pen working here on the pointer. If we are looking at XYZ and it is less than $100 stock, okay? My rule of thumb is the bid to the offer in the option montage, which is that screen I showed you with all the theta and stuff. It needs to be less than or equal to about 10 cents to the bid offer. So you want to kind of keep that rule in mind during open market operations. It's not going to fit the rule right now when we're looking at it. And it may not very well fit the rule right now because volatility is astronomical right now. I mean, we haven't seen this kind of volatility in probably 20 almost 20 years, at least 10. I don't think it even got up into the 80s during 2008, 2009-ish area. And then if it is ABC, which is greater than $100 stock, then we move the decimal. We just move the decimal 3 ticks, 3 places. All right, so basically you're taking, $250 stock, right? Decimals right here, you're just going 1, 2, 3. So it should be less than or equal to 25 cents in this example. Okay, that's not fitting the rule right now. Right now, $250 stocks, we're looking at like $2.50 wide, which makes it a little bit more difficult. But generally speaking, that's the rule we're going to be looking at. Right now, you're going to have to do a little bit of price discovery, which means don't always hit the bid or the offer, you guys. There's better markets out there that you're not seeing. Just trust me. I'm not going to go into the lean of the lean of the lean and stuff like that. But there's all kinds of spreads out there that these machines that we're using are trying to auto leg, which means if it can buy one and sell the other for your price, then it's going to do that for you. So, normally I would say maybe go mid-market or something like that. Right now, I would start out a little bit higher than that and do about 5 or 6 cancel replaces, right? I'm not saying wait forever. I'm saying put that order in there at a price you don't necessarily think you're going to be able to achieve. And then by the time you go back, cancel, replace, move it down a couple of pennies, or actually up a couple of pennies because you're buying this for a debit. So a little bit below mid-market, I should say maybe, and then bid it up until you get filled. I would not ever go to hitting the offer on a spread. You should definitely get it closer to about the mid or maybe just a little bit higher than that mid price right now. And that's kind of where I would stop. Just don't give it up right away. Can you give a little bit more on the break evens? Yeah, I will here. When we pull up the trading platform, I'll get into that a little bit more. All right, the right environment. Now, I usually talk about this because volatility, I talked about this, vol goes up, in further duration, further days to expiration. Well, right now, what we would want to see when vol goes up in further duration expiration, my rule is basically if it's less than 2%, which is crazy right now, 2%, that's a green light. That's a greenie, all right? If it's basically 3 to 4% increase from the front to the back, then that's a yellow light. All right, and if it's greater than 4% increase to the backs, all right, that's a red light. All right, so that means we kind of want to back away from it. This is on an increase, further duration, as it goes out in time, right? As we go out in time, this is what we don't want to see. Right now, what we're seeing is vol is in the near duration, is near. So basically, in the further duration, basically out here, we're seeing vol go down. So it's higher here, vol's high here, and then vol's further down here. So, because we're selling a put here and buying a put here, we're okay with that. Any volatility decrease is good. All right. So volatility, which is rarely seen lower out here, that is a good thing. And that's kind of the environment we're seeing right now. Just make sure that volatility does not increase substantially in those back months. Actually, here, I'll pull up a platform real quick. Show you what I'm talking about here. Let's go back to this. So what we're seeing right now, this is Vega, volatility. Vega is volatility. Theta is time. Gamma goes with delta, all right? Delta is all your data, all right? So the Vega is volatility. Usually, the further out in time we go, this number increases. But we can see that it is a dramatic decrease. So when we're selling this, it's pumped full of volatility, and we're buying these with much less volatility. That's a good thing. All right. We're buying less volatility than we're able to sell. Is this a backwardation or contango thing? Yes, it is. Right now, it's in backwardation. Backward down is a way to remember backwardation and contango, you guys. For some of you guys that are newer, if you ever hear that like thrown out on TV, just remember backward down is backwardation, and contango is the back is higher. So right now we are in backwardation. So backward is down, which is a rarity, very rarity. Usually it's higher. Usually when the front month is higher than these back months, it's because there's a binary event or an earnings going on in here, and we don't necessarily want to do this strategy in that type of scenario. All right, we would avoid that. We want to have clean months in that. Back month where we are buying it, we wouldn't mind having a earning event or a binary event in there, because we would expect volatility to at least stay at these levels or expand, which helps us, right? If we're buying this and volatility goes up, that volatility adds in there 9 cents for every 1 percentage point increase, all right, goes in there, or 9 cents away from every percentage point decrease. But you can see with this, if volatility starts going down, this volatility is probably going to be more precipitous than this one. So that will help us, okay? JQ, did I answer your question there? Backwardation, backward down. Contango is higher. All right. Vega is higher in the further month, which is okay. Well, right now, Vega is lower, 94 versus 130, okay? That is a great scenario. Like, you don't even have to go with my rule there. But normally speaking, if you are trading in a regular environment, this usually increases, kind of like what we see here between these 2 months. Let's just call it between these 2 months. It goes up, right? Goes from May to June, it goes up by 5 percentage points. That would be an increase too much for me to really want to deal with, all right? So I want these to be relatively close, all right? You know, for instance, you know, from the weeklies to the other weeklies here, you got a 50-point increase. I wouldn't want to do that because I'm buying too much volatility in this one versus this one. So just make sure that if it goes down, if it's in backwardation, you're great. You're good to go. Vega, well, that's because Vega here, so he's saying Vega is 9 cents versus 4 cents here. Yes, and that is atypical because volatility affects the further duration months more, right? But we're seeing what Vega or implied volatility is, and volatility in this front month is much higher than in this back month. Okay, this is the number I'm looking for here. This. So this is the number for the rule, implied volatility there. So if it goes down, like in what we're seeing right now, you're getting paid for taking this volatility here versus what you have to pay for out there. All right, the duration. We basically want that front month to be good theta decay. And usually you're going to get your best theta decay happening right here. So, you know, this is where we want to sell our put. And then basically out here, we want to buy our put. Whoops, buy our put. All right. So we're buying out here, and this is theta decay, right? So theta decay starts increasing the closer we get to expiration. So on the one we're selling, we want to sell high and buy low. So you can see that volatility, or sorry, the theta coming out of this is much greater. So that's a good thing. We want that to happen, and we want to retain that value here. That's why I said if we took this strategy right here to expiration, then that front put would expire worthless, and then that back put, would probably be, right around in here somewhere. So you can see that in this time, our put that were long only decayed by a very little bit, whereas that front month one just tanked, right? Okay. No questions so far? Does that make sense for everybody? I'm trying to get you guys to think about this logically, not just memorize this stuff, but how is it logical to set these up like this? I mean, once you go through my webinars and go through the logic of it all, I believe that it's going to make it stick in your mind much better if you understand all the mechanics that are going into this, all right? Picking the right strikes, it's the same strikes. We don't have to worry about that. One of the more important things is, thinking about your directional assumption. Do you think the underlying, if you think that the underlying is just going to go like this, then, you're going to be looking at the 45 delta. If you think that the market is maybe going to kind of trickle off like that and then, tank, then this is probably like the 36 delta kind of thing. Okay. Because you want it to go out here, my short put kind of does this, and this is where my long put is, right? 40, I could say you go like that too. And, this is your short put and this is your long put. Because I like to have this short put, equal 0 at the end of the day. If you get that slow trickle down to your, 36 put or your 36 delta put, that's at expiration right at your strike location. That's where you're going to achieve your quote unquote max profit on your thing that'll kind of go like this. That's kind of how it ends up working out. Is your timeline. These should be equal across the board there. But it's a little bit of a kind of like that. It's still not that great, but you can see how it's a bit skewed to the call side a lot of times. So picking the right strikes, we're picking the right strikes by thinking about our assumption, how we think this market's going to go. I usually like to pick this one down here because it gives me a little bit of wiggle room to the downside right away. And you have a tendency to capture a little bit more of that move if it happens right away. You'll be able to cash out. All right. Pretty simple so far, right? 45, yes, you're either picking 45 deltas for both legs, different months, different expirations. You in the duration, your front month is going to be 35, closest to 35 days to expiration, right? Right now, we don't have that. It's in the 20s, but we're going to be okay because volatility is so pumped up. And then this one, I like to say, basically 90 days to expiration is kind of my thing there. And the strikes here are the same. But you want to try and discern what your directional assumption is. If you think it's this one, then you're going to trade sideways. Maybe it's at the point of control and, or stuck between two Fibonacci's, and then it's going to fall out. Like, say, for instance, Las Vegas Sands or Wynn or one of the cruise lines or something like that, where a rising tide lifts all ships. Yeah, it looks great that they're all getting money for bailouts or airplanes, United Airlines. But if everybody in 2 months is still too afraid to travel on an airplane or get stuck in a petri dish, then they're probably going to start seeing those numbers fall off and tank, right? Once they use up all their money. So think about your assumption and how you think that these underlyings are going to react in the near term versus down the road. To me, I think there's a lot of them that are getting some buoyancy right now, and people are coming in and buying them, but I still think that they're going to have a long road to recovery, and that could hurt down the road. So I'm going to try and pick things for this type of strategy that will meet that assumption, right, of what I think is going to happen going forward. All right. Basically, what I look at is if this is going to be increasing, so our exit for me, I'm going to look for it to increase, 30 to 50%. Now, we talked about this. You're risking 1 to make 2, right? Well, I'm not going to ride this out to the end of the day, you guys. I don't want to stress out over my short put being, in the money or out of the money, getting assigned it and everything else on the last moment of the day. So I like to see this increase 30 to 50%, which would mean that if I paid like $1, if I paid $1 for this strategy, just to make it simple, then I'm out at $1.30 to $1.50, right? Now, a lot of times, if my short put expires worthless, right, I have a tendency to ride that long put out, okay? I didn't pay very much for it, and I'm probably going to ride it out, or maybe sell another put against it to try and lower some cost basis on it or whatever. But ultimately, the idea is get out 30 to 50% of increase, of what you paid, you're out. And because it's a defined risk strategy, if it goes against me right away, I'm probably just going to let it get out for my max loss there, which is that debit you paid, all right? And yes, you can look to roll those short puts out in time, continue to lower that basis. Hopefully you can roll it out and maybe turn it into more of a diagonal or something like that too. You don't always have to, when you roll it out, go to the same strike necessarily, all right? And you can use weeklies as well, yes. If it fits that rule of, picking the right underlying, it's still going to need to have those weeklies be pretty tight bid ask. All right. So here, we'll pull up the platform here without boring you guys much further and throw some examples in this around real life of what we kind of did. So I already did kind of an example on Las Vegas Sands, right? Where we were looking at that one, I'm starting out with selling the 36 Delta. So this one's not always going to be exactly that. And you can see that my days to expiration were as close to 35 days to expiration. These 50 days, that's going to be a point of contention. If this got down, next week, I would not probably be doing these 22s. I'd probably be going out to the 50s if it fit that rule. We don't want it to see increase more than those parameters that I talked about. And this one might not fit that rule now. But this one's kind of primed for it, right? We're selling the 36 or as close to the 36 Delta, the 45s, come out here, buy these. Like I said, it's going to throw me to the mid market on this. I'd probably go down, maybe $2.08. Just see what happens. I know that when I put it in, I'm probably not going to get filled, but I would say confirm and send. By the time I go over to my platform, change the price, go up, confirm, send, maybe 2 pennies or something, confirm and send, because it doesn't cost me anything to not get filled, right? You might as well do free market price discovery and let the algos come in there and figure out if there's actually, a $6 offer in here I'm not seeing. Because sometimes that can happen, especially in these further duration months, because there's all kinds of spreads out there and stuff like that that are trying to get filled. So there very well could be a $6 offer, $6.25 offer that would auto leg me into this spread. All right. So do that. Go up to maybe a little bit higher than mid-market on it with these wide markets to get filled. Just do a cancel replace, in the matter of minutes. I'm not saying wait 15 minutes down the road before you switch it. I mean, I'm literally saying you say confirm, send, go over there, change the price, confirm, send, That's the right way to do it. One of the worst things I always say, you know, one of the cardinal sins of trading is if you put an order in and bing, you're filled. Most likely, you just gave up edge. You didn't give everything a chance to sort itself out. But the free money will keep all stocks up. Well, yes and no. I mean, how long is that free money? I mean, these say for instance, like Boeing and the airlines or the cruise lines. I mean, we're not going to continue to bail those guys out. I think for those guys, this is kind of a one and done thing, and you know, they're going to have to either swim or sink. So they're going to get buoyant right now. But you know, I think that these petri dish type places are going to really struggle, like the casinos, especially. You know, a lot of these casinos are over in Asia. You know, Wynn and Las Vegas Sands have a lot of market share over there. So I think that those guys could hurt. I mean, who wants to go on a friggin' cruise line right now? Not me, but so I think that those guys might get this little bit of a buoyancy and get that move that we're talking about. We get a little bit of an upside move here, which is what we want. And then, you know, down the road, you get this kind of move right now, and then down the road, sell off, right? I don't mind that. You know, I always say, in order to get filled, you got to get run over. Anytime you get filled on a trade, it's probably because it's going against you, at least right now. I mean, if you don't get filled, then yeah, you were right, but you didn't get filled. So sometimes you had to. I had a convention in Las Vegas, and it's already been canceled. Wow. Yeah. Assumption is bearish, so puts, yes, are neutral to bearish. You know, you can be neutral if you're picking the at the money strikes, but bearish if you're picking the 36 strike, the 36 delta. Okay. So Las Vegas Sands was one that we did. You know, we already did that one. You know, let's look at the airlines. UAL is down a little bit today, but they have gotten this bit of a bounce, right? Volatility is coming out of it, but we get this little bit of a bounce. Maybe it comes up to 45 or something like that, whatever the case may be. I'm going to be looking at doing this one on a sell-off here. So I'm going to look over here at the 36 delta, which we get. So the 36 delta, 36 delta, selling those, and then coming out here and buying the same strike, which is the 34 strike, and buying those. All right. We take a look at the, somebody wanted to know about the break evens on this. Oh, let's just get rid of, which one did I have? Which one am I doing right now? I don't know. There we go. Came back in. So there's a break even to the upside. You can see how I was trying to draw that where it gets a little bit funky there. And that's because right now we're trading at the current price is, what was the current price on this? 36. So the current price is 30, I should have known that. 36.21-ish right here is where we're trading. So you can see that we need a move to the downside to that 34 strike to get our max profit, but it's a little bit skewed. If it goes down too fast to the downside, you can see that we have two break evens. One's to the downside, one's to the upside. And you can see what I said. Basically, you take the 34 long put, break even to the downside, we subtract this $2, so we're $2.50. So we're at 31.50. You can see that that would be my break even, would be saying it's right around here or something like that. But you can see it's dramatically lower. That was just something we used to use on the floor just to give you a ballpark. Right now, you could say it's like 3 times that because of the volatility in there. Do you look at open interest? Great question, Wally. Now, more, and that is a great question because right now I'm talking about the wide bid ask. You know, my rule for UAL to be able to trade this is it's less than $100 stock. So we look at the bid ask on normal operations during open market operations. Right now, everybody's canceling their orders. So yes, my rule is less than 10 cents wide on something like this, and it's not going to fit that rule even closely right now. But even during open market operations, it's not necessarily fitting that rule. So Wally, yes, open interest, volume and open interest is probably the better gauge right now. You can see there's some good volume and open interest going on in most of these as well. So that means there's more eyeballs on there. You know, if there's a lot of open interest, that means there's a lot of eyeballs watching these markets, right? Because they have an interest in what's happening. If there's not a lot of volume and open interest going on, then yes, you want to walk away from it. Why? Because you're going to have to give up too much edge. There's not a whole lot of free market price discovery going on if there is low volume and open interest. So my rule is usually, because if it fits that rule, there is the volume and open interest going on in that underlying. Okay. So that's why I kind of made that rule, came up with that, and how I came up with that rule is because, you know, if there's a lot of volume and open interest going on, then there's free market price discovery going on like crazy, which means we're all following over each other to make better markets, and they become very tight. Whereas if there's only one guy in the game making markets for you, he's going to make them astronomically wide because he's just waiting for somebody to give up arbitrage, doesn't know what they're doing, and tries to bid it up too much. Right now, the reason why these markets are wider is because of that volatility, and there's risk. Right? You have to think about the people making the markets in here generally don't like to have a whole lot of risk. They want to offset that. They want to hedge. So, you know, if they are selling a call, they're going out there and trying to buy the underlying. And if the markets are moving at, you know, 50 cents a clip or $1 a clip, well, they've got to be compensated for that type of hedging risk. And that's why they make them a little bit wider so that, you know, there's a little bit of wiggle room for them. You know, when volatility is normalized, you know, even at a VIX of 25 or 30, we would see these markets fit that rule. Right now, VIX is at, you know, 60 or something. I didn't see where it closed out at, but it's crazy high. But in this, look how much we're getting paid for this front month volatility versus what we're having to pay for volatility back here. That's a pretty good trade-off. And my rule for that tight bid ask isn't in these back months, it's in the spot month, the one that is the closest to expiration, monthly closest to expiration. Yeah, VIX is 61. I saw it when it dipped below 60 earlier today, but I wasn't keeping track of it at the end of the day. I was preparing for you guys. I was getting all my jokes lined up, which, you know, didn't work out very well at the beginning of the webinar. Nobody laughed at it. Anyway, so basically, this is a good environment. You know, yes, volatility, we could argue implied volatility is really high back here. That could hurt us if volatility starts decreasing because volatility affects the further duration months more than the nearer duration. But listen, I am getting serious volatility in this front month that I can take advantage of that price versus the back. And we don't have to worry a whole lot because we are a defined risk strategy. I know my debit paid is all I can lose. I know that my profit is I'm risking $2.44 to make almost $5. So that's a pretty good risk reward, right? Probabilities when the risk reward is that good, well, the probabilities are slightly less that I can nail that number at 34, which is why I like a little bit of wiggle room to the downside. I would obviously like to see United Airlines maybe try and make a bit of a rally before it falls flat on its face. Okay. And if, you know, that front month decay is worthless, I'm able to ride that put out, and we get that sell off again, we're going to see that volatility expand. By that time, volatility will probably be affecting that back month a little bit more, because we'll have that massive theta decay happening in the front month. That'll help us out. Volatility, as it starts getting closer to that expiration, to start subsiding a little bit. That'll help us out in that front month, right? Anybody else have any other questions? It's pretty simple to set up, right? Because it's the same strikes. The main thing to keep in mind is we don't want this to increase too much. You know, like this one from the weeklies to the 50, you can see that massive increase. We wouldn't want to see that increase. Right? It's over 5% increase, which is, you know, pretty easy to do. We don't want to do it because we don't want to be paying for all this volatility in the back month versus what we're able to sell in the front month, because if volatility comes out, it's going to hurt us. All right. In this case, if volatility starts coming out, ultimately volatility is going to, in pennies terms that we looked at in the Vega, 3 cents versus 7 cents. Yes, volatility starts coming out, it's going to hurt us a little bit, right? Well, volatility starts coming out, this is going to drop like a rock. So it's going to be offset. That's going to help us, especially with the theta decay. We can look at the theta decay, you know, versus back here. Theta is not going to change on it based on the volatility. So that's going to help us. So we can get it done nicely there. So there's 2 break evens. Yes, if this market starts rallying too much, then, you know, that break even to the upside, we're going to, you know, lose that debit because we're long a put, right? Yeah, that short put's going to decay worthless. This short put will decay worthless. This long put will also decay worthless, right? So, you know, if it rallies straight up, then we have a debit to the upside that we have to worry about. If it goes off to the downside, you know, during the next 22 days, we have that short put that is going to start hurting us, right? If it starts happening right away, that short put's going to hurt us, and it's going to offset how much it helps us in the back months. All right. Because right, we're dealing with very close in deltas. So if it starts like really selling off, well, everything starts being equal if it goes too far, too fast. The upper break even is the long put. Is basically 2 times, at this point, it's 2 times the debit. Ballpark, it's not, there's no way to figure out exactly easily how to figure out the break evens other than pull up your analyze tab. That's probably a better thing than what I would say. But my thing is you basically subtract the debit paid from the strikes, that's your break even, and then basically it's like 2 times the debit paid to the upside is your break even from where you are. Yeah. And it's a complete ballpark on that one. That's just to give you, and that's a conservative ballpark. That's, as a floor trader, we wanted to know what like the worst case scenario was, which would be very conservative. Worst case scenario is I subtract the debit paid from the strike, and that's my break even on the downside, somewhere right around in there-ish, somewhere. And then 2 times to the upside would be, you know, right in there or something from where we're at. Actually, 2 times the upside would be right around there. So 2 times the debit paid plus where we are now or to the downside. A loss at deeper correction within 22 days. Yes, it's a max loss if it immediately goes down. You know, you put it on tomorrow and these UAL falls out of bed or Las Vegas falls out of bed, you're probably going to be close to a max loss if you let it continue to go, right? I would say that if it goes down there, as soon as you see this 30 to 50% increase that started moving right away, you're probably leaning towards a 30% increase. If it goes down there and kisses your short strikes, you're likely going to be close to this 30% increase in what you pay. So on a $2 one, you'd be looking at $2.60. So, look to cover it. That's why I always say, my exit strategy is never that max profit kind of thing. I'm looking for the market to come down. I get it right. I'm looking for singles and doubles. I'm the jab thrower. I'm not throwing roundhouses. I'm not trying to get a knockout in the first round. You like the theoretical price on TOS to see how option price can change due to volatility price? Yes, I do that too. Can you create a list P&L at a fixed time interval to see how time and theta K volatility, aka theoretical price? On the P&L, I don't know how to do that, Wally. You might know how to play around with those things a little bit better. I know how to do the theoretical price and stuff like that, but not the other. You throw something in there, I'll stick around to try and play around with that. Give me just an idea of what we're talking about. But for everybody else who doesn't probably maybe not want to stick around for that, I'm going to throw in an offer into the chat window. We've been going back and forth in the questions box. There is a link in the chat window. I think I doubled it up that you guys can use for pulling up the offer, which I just did it to make sure it works. So this is the offer. Premium options education service that you'll have to type into your URL if you aren't watching this live. Otherwise, you can throw it into your cart. This is a great one because you guys, there is all kinds of content in there for the premium education service. Also, you get unlimited access to me. I know a lot of you guys have been taking advantage of this and reaching out to me almost on a daily basis about your portfolio and how to protect it and stuff like that. I've been going back and forth in emails almost constantly in the past couple of months with some of you guys. So, I appreciate you guys' business, and I want to make sure that you guys enjoy it and enjoy this trading that's going on for sure. So basically, you get the daily micro commentary videos with options. The one thing that's not listed here is that access to me. And if I can't answer you in an email, you guys know I've called a couple of you guys and we've kind of worked through the problem. Online access to over 50 videos. You also get free or priority access to the trading workshops. Premium members also get all the trading courses. And what I'm talking about with the trading courses is the different ones. If you're a beginner, you could start out with this one. Yes, you are going to see the short call butterfly somewhere else, or the, this long call, or we're doing the long put calendar, right? Well, options for intermediaries too is designed differently than what we're talking about in implementing this strategy into your portfolio. We have different things that, different ways to implement it or to design differently in that educational course. All right. So it's not always the same. Plus you guys have driven the content in this one. It's, a little bit different in those other ones, and it'll help you remember it because I may have forgotten to talk about something in this one versus the other one, or remember to talk about something in this one versus the other one. So also high volatility strategies. This helps you if you're just trying to narrow it down. You know where the volatility is in a particular underlying, and we work it through and narrow it down to the correct strategies, or if you just have a market assumption. So all of them are a little bit different. The link is down here if you're watching it on tape delay, or in the chat window if you're watching this live. So take advantage of it. If anything made sense to you, how I teach, you guys should take advantage of this offer for 97 bucks. Also, if you've ever wanted to like a mentor or something like that where you can bounce ideas off of, take advantage of it. It's worth it. Yes, you can get some information free on TV or online, but they aren't going to talk about specific strike locations and make it like so that you guys understand why it is important to kind of to do it the way that I'm doing it. And as a matter of fact, I debunk what some of those guys are saying on TV, give you reasons why that isn't a good idea. Yes, it's free, but it's going to cost you in a bad trade for setting it up incorrectly. So take advantage of that. And finally, I just want to thank you guys all. Different option components. Different webinars. I'll drill down on option components when and where I find them appropriate. Here's the link to the special offer right there. Again, it's not a hot link. You'll have to type it into your URL if you're not watching this live. And thank you for watching. If you have any questions, comments, or webinars you want to see done, reach out to us at 310-598-6677 or email me at trading@protraderstrategies.com. All right, that's all I got for you guys. Other than one other thing we got going on here, JQ, so you better hold off. This is the new disclaimer. Ha, I gotcha. JQ always tries to beat me to the punch. Go over this. Basically, it's talking about we are an educational company. We are not trying to get you guys to lemming off the cliff with me. And remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, JQ, got to you a little bit early, but if you can't take that, take it easy. All right. Thank you for an awesome webinar, a lot of information. Thank you, Alexander. Appreciate it. Thank you for your time. Paris, thank you. Appreciate the kind words. Twitter slang-wise, Alexander, I'll have to check that out. Whatever your link is there. You click on my link, I'll click on yours. Rusty on toss and options trading. Yeah, we'll try, albeit a year ago, but it's been a bit rusty. I'll throw that. Let me throw up the platform there and see if we can't like whittle through this.